Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Welcome back to another episode of the Tech Behind FinTech. I'm your host, Anandio Swagu. Joining me today is Jon Jacobson, CEO of Omnisient. Jon, welcome to our show.
Hey, Namdi. Thanks very much for having me.
Hey, no worries at all. So look, we're super excited for the show. Today, let me bring the title across the screen. Redefining Creditworthiness, New Era of Credit Scoring for the Unbanked. So we're going to get into Jon's bio, but what's really interesting about this show is, we're all used to talking about credit. If someone has a bank account, credit history, what if they don't? How does that process work? So Jon's doing some really innovative things there. I want to bring him on to talk about it. Before we get into that, let's do some housekeeping. First of all, we are streaming live from Facebook, LinkedIn, YouTube, Twitch, and also we have a separate stream going from Instagram. If you're on Facebook, LinkedIn, YouTube, or Twitch, feel free to drop a comment. We'll add your post to the show. On Instagram, it's not integrated, so you can go to the Tech Behind FinTech, which is pinned, and then you can see the show from the Tech Behind FinTech by clicking on one of the links. Most likely, it'll bring you to YouTube. If you're interested in watching there, you'll see just more than my face. On Instagram, you just see my face. You're not seeing Jon. So go to the Tech Behind FinTech and you can see the whole show. So that's it for the housekeeping. Let me move into Jon's bio so you can learn more about him. And we'll jump into the topic of the day, redefining creditworthiness, the new era of credit scoring for the unbanked. Jon is a software engineer and visionary entrepreneur of over 25 years of experience in building businesses, raising capital, and designing consumer data software platforms. Jon's first leadership role was at Credit Suisse, first Boston and New York City, where he led the global financial reporting team in delivering a suite of applications supporting over 300 financial controller users across CSFB globally. In 1999, Jon returned to South Africa to build an innovative, first-of-its-kind multi-channel marketing platform, which eventually grew to support global omni-channel marketing campaigns for major FMCG brands such as Diageo and Levi's. Jon's current venture is Africa's first privacy-preserving data collaboration platform business, Omnisient, where he serves as CEO and CTO to lead the business in building the world's biggest source of consumer intelligence. Jon holds a Bachelor of Science in Computer Science, Economics, and Mathematics from Rhodes University in South Africa. When Jon's not in the office or spending time with his family, you can find him sparring in a boxing ring or in the ocean surfing or diving. Love the bio. So before we get into business, we have to talk about boxing. I'm a huge fan of combat sports. How long have you been boxing, Jon?
Sure. I've been boxing. I kind of stopped boxing probably a couple of years back. Took a couple of eye injuries and then I couldn't had to stop fighting. And once I stopped fighting, then I stopped sparring. You know how it works. You kind of go backwards. So, but I boxed for a long time, probably close to 20 years.
Oh, awesome. So you a professional fighter or amateur ranking or?
No, just amateur. No, I got into white collar boxing as when I started. I just found it as a really good stress release. You got all of this business pressure. It's good to get in the ring and and work it out. So I worked with I was at a local gym here, a boxing gym, but you get to you train, you spar, and every 3 months you can fight. And so I just did that.
No, 100% love it. So a few years back, I was heavily into striking and did similar. It was more of a, we train and then we spar. Never took a match, but it was just sparring with my guys. Some of them went on and to fight in pro or high level amateurs. I transition more now into grappling and jiu-jitsu, so I don't strike as much. I work with a coach He holds some pads
Yep.
every once in a while, but I'm more on the grappling side. But, you know, I tell everyone, right, you can run, and I do run, I swim and all that, but it's a whole different element when another human being is trying to cause bodily harm against you. The level of cardio increases dramatically.
Yeah, it's like Mike Tyson says, right? Everybody's got a plan until they get hit in the face. So it's kind of
100%. So I totally respect combat sports and practitioners in whether it's striking, grappling, and so forth. So I think that's pretty cool. And you know, in another side, we can spend a whole show talking just about that, and I can go into it. But today's topic is about financial inclusion and the unbanked. First of all, I want to congratulate you, right? So I read that your company, you won the most innovative financial inclusion technology at the Africa Bank Summit 4.0. Can you talk about that?
Yeah, no, that was so it was amazing recognition. We've been going probably since we incorporated this business in December 2019, January 2020. You know, so in that process of building the business, we started locking into a particular kind of opportunity. And what we realized, well, we kind of knew this from the beginning, which was that there are sources of data out in the market that can be game changers for certain aspects of financial services. And one of them is obviously that credit and credit risk. You know, I think 1.7 billion people globally don't get access to credit, right? You're talking close to 2 billion, so you're talking 25% of the world's population. And a lot of that problem is because the credit bureaus have a monopoly on the kind of data that defines what credit is or isn't, and whether it's the likelihood of someone to default. And so if you can start bringing alternative data sources into play, like retail data or telco data, then you can kind of start making some big impacts in that area. And so what we did was we partnered with a local retailer, and through them, and because of the way the platform works, it means that the banks can actually model data in our cloud. So it's a privacy enhancing technology in the sense that it's the data is anonymized to the point where collaborations can be built in our cloud and data ecosystems can be built, but there's still the basket level data. But what you really need is, you know, the retailers themselves don't necessarily have the skills, or historically wouldn't have had the skills to build credit risk models, but the banks have been doing it for 30 years and they know what they're doing. So you kind of need to have that environment where the retail data can be put into play with no risk to the retailers. So no intellectual property risk, no privacy risk. Privacy law is a big deal. And no kind of breaching or hacking, nothing that can actually compromise their trust that they have with their customers. So we built that layer and we patented that, and that's kind of was the underpinning of the platform. Then we started putting retailers and banks together, and through that, what we could do was we scored 8 million new people into the credit economy. So we could put scores to 8 million new people that the credit bureau couldn't, and of those, 3.2 million could get access to credit immediately. And in the context of a country like South Africa, say 12 million people are roughly what would be called thick file, or would have access to credit. When you add another 3 million, you're adding 20% to the credit economy. I mean, it's significant, and so I think that's probably the reason why we were given the award, because it was a bit of a game changer.
That's amazing. So you said it's a lot of stuff. I want to unpack it like one by one. You have a person that has no credit history coming in. Help me understand, right? And they don't have a bank account as well. Is that accurate?
So they might not have a bank account, but what they possibly might have done is applied for a loan through a bank, right? They don't necessarily have to have the bank account to apply for a loan. They might or they might not. Sometimes somebody will have a check account, but they still won't get access to credit because they're not credit worthy. So it could be or it could not be.
All right. So having a bank account, either way, they might or might not have. But what they don't have is any form of credit history. Is that accurate?
Correct.
All right, so they don't have a form of credit history, right? You have a platform now that you describe. How exactly does the retail interaction work with the person without the credit history? What type of data do the retailers have to help the banks understand this person's credit worthiness?
Yeah, it's a very good question, right? So you think about it, historically and even up till today, people are being scored based on their lending behavior. And that's what the bureaus get. They kind of get data from lenders and then they'll score you based on that. Now, obviously, people don't lend that often. So that data can be very disparate and might not have changed over time. And so typically what you're looking for is, typically you want 24 months of data. That's before you'll even think about building a score and actually creating a credit record for that individual, or the credit history of 24 months means you can create a credit score. What's happening in the shopping world is that, well, there's a couple of things. One is people are shopping. So the recency and frequency of that data, it's happening a lot more often. And because you've got spend behaviors as opposed to lending behaviors, what you can do is you can start determining features out of that. And that's kind of what we did. We went off and we determined features out of, which is kind of how you build any kind of model. Basically what you're doing some kind of feature generation. And then on the back of that, you'll build a model. So we, for instance, worked out certain things. One of those things would be if somebody's, and obviously what's fundamental here is that there's a loyalty program. So you can tie an individual to their spend behavior. Because obviously, as most people know, is that if it's just a cash transaction, well, how would you track it? But because there's a loyalty program that's underpinning this, and there's some kind of retail media network that's wrapped into this, you have a vehicle for one, gathering data, identifying information, and then potentially also putting an ad out in front of that person so they can actually take up that offer, right? So in the case of spend behavior basket data, what we started determining was things like if somebody's spending, like in my market, let's call it 40,000 Rand, let's just say they're spending $2,000 a week. That's a fair determinant that the person has decent income. And when that person is using that, is buying fresh fruit, veg, 60% of the time, there's certain features that you can build out of that, because really what you're doing when you build a model is you've got a target, and what's the target? In this case, a target saying likelihood to default, right? That's really what you're trying to determine. What's the likelihood to default? You can actually build accurate credit risk models on other data, and that's what we did. We built very accurate credit risk models on shopping data, which is a pretty good determinant of whether somebody's likely to default or not. And it's based around those kinds of features, spending X amount every week, consistently, spending it in a good way, not buying loads of booze and cigarettes, but buying fresh fruit and vegetables, buying stationery for the kids, things like that. All of that becomes features, and it's actually no different to how a credit risk model is traditionally built on lending data. It's just that you flip out those features and you bring in new features. And I think what we were able to do is that our banking partners that had built these models with us, alongside with us, those models then have to be approved by their credit teams, because in a bank's heavily regulated. It's not that simple. You just build a model and off you go. The credit team themselves have to validate and approve the models. And I think that was the big thing for us, because those models are approved by the banking teams and the credit teams, the guys that do the model vetting, and they're approved. That means that model's as good as a bureau model.
All right,
Did that make sense?
No, it totally makes sense to me. I want to unpack it so our audience understands, because first thing you said, right? If it's a cash on cash transaction with no tracking, you're out of the game. You can't do anything with that type of customer. So, we're all familiar with going to the grocery store, you sign up for the shopping cart, you get a unique number every time you shop, it tracks it. Sometimes they give you certain rewards, bonuses, but now you have the spending history based on that. So that right there, from my understanding, that is a key element in this particular ecosystem that you built out to relate the retailer with the customer. Is that accurate?
Yeah, that is. It's 100% accurate. And also what really worked for us is a lot of the big retailers globally, and whichever one you're thinking of, have all also adopted this process or programs, these retail media networks that they've implemented, which means it's really a vehicle for monetizing their shopper data, their rewards data. And so these things are in play. Typically, those programs have been built to monetize CPG data, from the large manufacturers, and that's like a no-brainer because that's what the retailers have been doing forever. The game changer, I think, and what we did differently was we started bringing in new buyers out of other industries, financial services, with very different kinds of data products, but you still had a vehicle to put that offer in front of that individual, that consumer. So as opposed to that person getting an ad for, buying some kind of chocolate, well, now you can get an ad that says, hey, there's an offer for you from this bank.
So I'm gonna break it down.
It's one thing to.
No, please.
Sorry. So, yeah. Sorry, Nandi, why don't you go ahead? I was talking.
Yeah, I'm going to just break it down even further. All right, so we have that step one, right? The customer loyalty program, as you just mentioned, right? It's a way traditionally was used for manufacturers to add more ads and things of that nature. But now you flipped it so that banks can now push some of their products. But the key thing is these people have no credit history. So a model has not only to be created, but it has to be approved within the bank that they could accept that as on par with traditional sources of credit. Is that accurate?
Correct. Yep, correct.
All right.
So what you then need, so what you obviously need then is you need this fairly sophisticated environment where you can build and train a model, and you have to be able to do it in a very safe, secure environment. And that's what we did with our cloud. We created this trust environment. You can think of it like a diamond glove box in a way where the bank can come in, they can model, they can do stuff. You can't take the data out. So the data is retained in there, and that privacy and security and trust layer that's built in there is really what gives everybody comfort. Gives the retailer comfort, gives the bank comfort. So, and it's a fundamental game changer to what had happened previously, because historically what would happen is a bureau would give you all the data and you'd model it, but the data is out of your control. When you're dealing with a retailer or a telco and you talk this and these first party or zero party data owners, that's not even an option. There's no ways you can say to them, hey, look, you're going to make lots of money, but you just got to go give them all your data. That making money is not, because the trust and the relationship they've got with their customer is much more important than that. So we created this environment where you can build a trusted relationship between multiple parties.
So I don't know if I told you, but I have the cybersecurity. That's my background. Like that's what I do for a living. And I want to definitely dive into the cybersecurity privacy aspect. But before I go there, I want to back up a second, because a couple of things that you said in the description that I really want to get into to get a deeper understanding. Shopping habits, right? This is something that I caught what you said, and I want to make sure we dive into it. In establishing this credit profile, traditional credit, we have Experian, Equifax, TransUnion here in the States, right? Going to buy a house, right? They're looking at, okay, how many lines of credit? What's your debt to income? No one's looking at the specific things that I buy to make any determination on whether they're going to approve me for this house or the car. But in your case, you mentioned, right? Grocery shopping, and they're buying, certain products, healthy products and things like that, versus if every week you see this individual buying alcohol or different things. How does that impact, or is that part of the model that impacts the determinant factor on them getting credit?
Well, it underpins it, right? Because it's all really on the modeling and how accurate your modeling can be. I mean, what we did was, So in this game, there's this concept of genie lift where which is really just another way of saying model accuracy. So traditionally, and this is what we found, is that, in the world of credit, there are two kinds of buckets of people. There's thick files. Those are people that would typically get credit. They've got credit scores and they've been scored because there's enough information on them. A good example of this is obviously somebody who comes to America with no credit record. It takes them 4 years roughly to get onto the bureau, and that's because of that process of having no history. So in this world, you could have a scenario very possibly where somebody doesn't have a credit history, but they join a loyalty program at one of the big retailers, and they build up a record of that, and quickly, within 6 months to a year, you would be able to determine the likelihood for them to receive a loan. It might not be a home loan or a car loan, but it would start them on the journey very, very quickly.
No, I totally understand that, right? Because now it starts generating credit lines. My only, I'm not gonna call it a concern, but I'm now fascinated by them, the credit being approved based on their shopping habits, not on the spend, right? So if you're spending, like you said, 2,000 Rand, 1,000 Rand a week, that's obviously one of the criteria. But it's now deeper into what exactly you buy. That can actually make a determinant factor on your credit, being granted credit. Is that accurate, or am I?
Yeah, no, it is. But there's an aspect to this that's maybe a bit nuanced, which is, remember, in our cloud, there is no personal information. So the modeling is not being done on an individual's data because we've anonymized all of that information. So what actually happens is, it's kind of almost maybe should start with the journey of how this actually all starts. It starts. Right. So when we built our platform, what we wanted to do was make sure that privacy was retained all the way through, but almost along the lines of the law. And we worked along the lines and built it along the lines of GDPR, which is kind of how the California Consumer Protection Act works, right? And so the best form of data is where PII, personally identifiable information, is anonymized. And we start the journey on premise. So no personal information ever leaves a business's environment. So when the retailer is pushing data up, and this is the layer that we patented actually in the USA, which actually what it does is it builds up a hashed version of that individual, but we basically invented our own hashing algorithm so that this thing could not be cracked, even at any point in time. But it starts off on premise, but it's interoperable. And by interoperable, I mean it's linkable. So if I, John, now become X3496, there's no Jon Jacobson anymore. There's X3496. Doesn't mean anything to anyone. But I'm also X3496 at the bank, and I'm X3496 at the bureau. And so you can build these data ecosystems in the cloud with all the data that's attached to it. So my basket data or any other data is still readable, but there's no John. There's no version of me. And in terms of the law, that's really what you need to sensitize. Healthcare law is different. We're talking about personal health information, but when you're talking about normal consumer data, really what you've got to do is you've got to desensitize, or at least sensitize the PII, the personal identifiable information, and that's what we did. So when all this modeling is taking place, you don't know what you can do is and you're not really modeling an individual, you're modeling on a huge amount of data, right? And you're training that model on all that data, and you're building features on it, and you're doing feature generation. So at the end of the day, it's true that your shopping behavior is the determinant of whether you're going to get access to credit or not, but it's not done at an individual level. And there is no way to identify an individual in that process. Only the retailer can do that later because it's their customer.
Okay. So from the banking perspective, they can't identify the individual, but they do factor in the shopping habits of what that anonymized individual is buying to determine if they're going to actually be approved for a loan.
Yeah, but remember, again, it's not so much what's happened here is, yes, so there is a credit score or a scorecard that's built based on shopper data, but that record is never unlocked until an ad goes in front of someone and that person consents to receive a loan, right?
Okay.
So he's got to consent to receive a loan, or she's got to consent to receive a loan. And only at that point in time can that record be unlocked. So really what you've got is you've got a whole lot of anonymized data with some kind of FICO score equivalent up against it, but you don't know who that person is, and there's no way to unlock that. That thing's pretty secure. At some point in time, the retailer can put an ad in front of that individual and say, are you interested in a loan? And if that person says, yes, I am, I consent, you can unlock it. So it's something we invented called post-consent. So because it is important, it's really, really important that people's information is never used in a way that they don't want it to be used. That's kind of quite fundamental, yeah. So while it's anonymized, it's actually not in use. It's only when you unlock it with consent that it is in use, if that makes sense.
No, totally. And I just want reasons I just go back and reiterate it. One, I just want to make sure I understand it. Two, I want to make sure my audience hears it again. So in this case that you just mentioned, yes, the data is anonymized. With what you invented with post-consent, me, the individual, right? I'm attached to this retailer. I get it based on the credit scoring mechanism, right? That you have your algorithm. I now get this ad for credit. If I'm interested in it and click onto it and consent, that's when the bank will actually, it becomes, they'll see who I am, so we can start processing the loan. At that point, do I start interacting directly with the bank, or how does that process work?
Yeah. So at that point in time, there's two ways this could play out. Actually, the one is you got an ad, and it would have come from the bank, and the bank would say, let's just say it's Citibank or Chase Manhattan or some bank, and it says, hey, Namdi, you have qualified for a $5,000 loan. Let's just say. Do you want to take the loan? Now, remember, the ad came from the retailer, not from the bank. The bank actually, it's basically because it's gone through the retail media network. So it's been pushed out through the retailer, because the retailer is the only one who knows who you are. The bank doesn't, right? So only the retailer can put that ad in front of you. A segment was defined of that audience of people which are now creditworthy, and the bank is effectively, I suppose, paying for the campaign to put that out, as opposed to a CPG company or a manufacturer, now a financial services business or a bank is pushing that ad out. So it comes in front of you, and it's from that particular bank. You say, hey, that's amazing, man. I've never been offered a loan before. And this is coming from a bank as opposed to a payday lender or whatever. So the interest rates would typically be better regulated and should be better. And you say yes. At that point in time, when you consent to yes, you've consented to receive a loan from the bank. And then at that point in time, the process, the workflow can kick in, where the bank can then hit an API and check your score. And that's all based on, but that consent process is quite fundamental.
When the bank hits the API and checks my score, when does my interaction with the retailer stop and my interaction directly with the bank begin? Am I going to another form to actually fill out an application? Am I instantly getting approved? How does that process
Exactly,
work?
that's right. Yeah, so there'll be a workflow, and what would happen is you say yes, your score is only checked, so the score is kind of basically checked now against you. Let's just say yes, the score is good enough. Then then you'll go through a normal application process through the bank's website, fill in a form. So that's the one scenario. The second scenario is you might just go to the bank. You might just go to the bank and apply for a loan, right? You might say, hey, I need a student loan or something. And at that point in time, the bank could also say to you, okay, we've tried the bureaus, the ones you mentioned, TransUnion, Equifax, and Experian, and they've declined. Do you use a retail loyalty program? You say, yeah, I'm with a retailer. They can check that at that point in time, and then can also unlock your score. But again, consent has happened because you've consented in the branch for them to unlock the score. So those are kind of the two scenarios. One could happen online, and one.
With the second scenario, and I'm consenting in the branch, what information do I have to give them for them to unlock it with the retailer? Is it my loyalty number, just my name, what information? Because every retailer.
Yeah, no, it's a great question. I mean, Yeah, it's basically so it's some way to uniquely identify you. That could be your social security number, it could be your email address, it could be your mobile number, combination of those with your last name. That would kind of do it. The way that we've built the platform is it's not, so we call this multivariate matching. So there's multiple different ways to uniquely match an individual across multiple different types of identifiers. But ideally, obviously, uniquely identifying someone is quite important. So it could be probably any one of those three. Or it could actually be your first name, last name, date of birth, city of birth combined with that, things like that. But all of those, obviously, in our cloud are anonymized. Those are now all tokens of things that can be used to build up, some kind of unique identity. So an identity resolution type process.
The only thing I'm not understanding that I want to get clarity on, just so I can get, because then the whole workflow will be 100% in my mind, is if I get the first side of it. If I get the ad outside of the bank, on the second side, if I'm at the branch now, I get access, and the bank now goes to your platform to find me, but the data is anonymized. How does that process work? In order, like, I know from a retailer side, I've never given my social security to a retailer. Like, they always get they get my address or phone number or whatever for me to get the loyalty program. I'm assuming that's not, you don't have that. I might be wrong, but I'm assuming you don't. But how does the bank then get that? How does it open up to the bank? Do they have to go to the retailer and say, I got this consent form?
Yeah.
How does that process work? That's what I want to understand.
So basically what's happening is, as I was explaining earlier, what happens is the data that comes in is we build out what we call a crypto identity, which is a cryptographic version of yourself. It's the exact same process. So that cryptographic version of yourself is based around the same kind of information, your email address, mobile number, social security number. We build out these unique crypto identities. Now, let's just say you went into the branch, well, you would give them social security number. If the loyalty program gathered social security number, often they don't, but they will gather a mobile number and email address. And so let's just say they asked you and said, okay, can we check your score? Are you happy to provide us a mobile number? Say, yes, here's my mobile number. And then that will get turned into a crypto identity in the process. The API will get hit and a score will come back. But obviously what's key in that whole process is that you've consented for that to happen. Because in this whole privacy world, consent trumps everything. Consent's the key. So if you've opted in or you've consented, that's the key. That everything that the privacy legislation and the laws trying to protect from is where people haven't consented, but they're getting barraged with ads or things that they haven't really requested or asked for. So consent's the trick.
Okay, thank you for that explanation. I get it now. I totally understand it. If the audience, guys, if you have questions on this stuff, please feel free to drop your comments or questions in so Jon can and answer it. I'm looking on Instagram real quick. I'm just trying to see if people posted any questions on IG. I don't see any questions on IG. If you have questions on LinkedIn, Facebook, YouTube, Twitch, feel free to drop a comment in. We'll dive into it. So it sounds like you made you gave people, like, they did not have traditional credit. And I want to get into the next. We have to take a message from our sponsor. But after I come back, I want to get into some success stories, like people who, they got this loan and they were able to go to school. They were able to do something for their business. Before we get into that, we have to just get a word from our sponsors, and we'll be right back.
Are you an emerging fintech with a limited budget seeking more sales and partners? Introducing Strategic Generation, your partner in leveraging cybersecurity for sales and partner enablement. Fintechs often lose opportunities due to unsophisticated cybersecurity programs. That's where we come in. Strategic Generation assists with due diligence, security posture visibility, penetration testing, and on-demand virtual CISO services. We connect your systems to our partnered platform, and voila! Instant access to real-time diagnostics and compliance frameworks such as SOC 2 and PCI DSS. Gain the confidence of prospects and partners. Strengthen your cybersecurity program and drive success. Stop losing deals due to cybersecurity. Visit strategicgeneration.com and click on Demand CISO to connect with an expert.
We're back. So, question. I mean, it's from obviously from the inclusiveness award you won. I'm sure there are like countless stories where someone, maybe they want to start a small business, they needed a loan to do it or send their kids to school. Can you have any cases like that?
Yeah, we're a bit too removed. I mean, also we kind of very early in the journey of this actually going live, but at the same time, we're just too removed. So we don't provide loans. That's not our game. We're not in the personal loans business, and it's kind of, so we don't see the consumer who's received that loan, right? I mean, but I think the principle here is right, which is, in my mind, what's incredibly valuable is where you've got, especially in a market like ours, you've got these young entrepreneurs who are trying to get going, and it's so difficult, man. I mean, it's like, and trying to break into the credit economy, and it's a bit of a catch-22. If you can't get going, you can't get going. So I do think that is absolutely what this should be all about, because it's actually really good for the retailer, it's really good for the bank, but it's also exceptionally good for that young entrepreneur that now can get a loan, and also at a very reasonable interest rate through a regulated environment and not through a loan shark or a payday lender or whatever. So yeah, I wish I don't actually have any stories to tell you. I'm too removed from the cold face of that aspect of it. But yeah, I mean, I think the sentiment's right.
No, I mean, listen, it's all good. I mean, you built the platform and you brought all the players to the table and they're interacting. So totally understand from the technology and the bank will probably have those stories. But no, I just think it's an amazing and very innovative platform that you've built and what you're providing, because everyone knows, man, whatever business you're trying to do, the funding for that business, no matter the scale, right? It can be selling art or crafts on the side of a road, right? Versus scaling up a fintech or buying, real estate and rehabbing it. Most people don't have necessarily the cash in the bank to just pay cash for everything. So getting a loan
Exactly.
to leverage that is extremely important. So I think it's pretty awesome. You were able to provide millions with that opportunity. I wonder, okay, so I guess I'm going to answer my own question. So let's say that someone without the credit, they get this loan, but they default on it. Now it's on their regular credit report. Now they have a regular credit score.
Yeah, that's right. So, and yeah, exactly. And then so and I suppose all of that then starts helping to improve the models that we do. At the end of the day, you kind of go off and train them on a very similar principle to what you would expect a normal credit risk model to be trained on. And but at the end of the day, obviously what you're trying to do is you want those indicators, those real determinants of, well, this person got let's just say hypothetically, based on our models, we gave them a really high score and then they went and defaulted anyway. That's going to be a determinant of there could be something in that process that needs to be sorted. We haven't seen that yet, but there's possibly scenarios like that, So, yeah, I mean, that's right. But then at that point in time, then they're into the game properly in terms of the credit risk game, and then they would have a proper record. I mean, where we get involved is more the invention of finding new ways of getting people in, right? Just so that they can actually be part of this process, because especially in a market like ours, you've got massive previously disadvantaged society with an entrenched kind of disenfranchisement out of the credit economy. This is like historical. It goes 20 years, 40 years, 50 years old, So you're trying to kind of almost rejig what's been going on historically, and you have to then find a whole nother way of doing this. And sometimes you've got to disrupt the status quo to do that. But I think it's worthwhile doing.
Do you get that feedback from the banks if someone paid their loan successfully or if they defaulted to add back into your model? Do you get that do you circle back with that information?
Yeah, I mean, I think like we're still pretty early in the phase, but absolutely we'll be getting that data back in. I mean, it's actually because it's just it's just the right, it's obviously what helps you to improve and make the model a lot more robust. I mean, when we started this journey, we kind of, what we were able to do was get really good Gini lift, as I was saying earlier, which is the model accuracy, and we could improve on thin file models by 43%. What you then want to do is you want to prove that. I mean, you want to prove that properly, that's great. Your Gini lift has said that 40% improvement in model accuracy versus what would typically be available or what could typically be done with traditional data. Now what you want to do is you actually want to make sure that kind of accuracy that you're getting is actually real. And the best way to know that is somebody went in and didn't default or did default, and at what, because obviously the scorecard itself has got different levels of score. So it's really like one of the ways to do this, I think, is you just start loaning. Typically, you might loan, say, on a FICO score of 500. Well, don't loan on a FICO score of 700, because at that point in time, you would have a more, the likelihood to default would be much lower.
So right now, you're I read a stat. I want to go over the stat with you. I read a stat. I don't want to tell false stats, so I want to make sure that I have the right stat. It was, do I have the stat? I don't think I have the stat. But I think, it's right here. So it was a 2019 survey. Obviously, COVID may have affected that from the FDIC. Approximately 5.4% of U.S. households were unbanked, which represented about 7.1 million households at the time. You're doing and brought the retailers in South Africa. Do you see infiltration in the U.S. in your journey?
Yeah, absolutely. Yeah, I mean, we are talking to retailers in the U.S. and there is absolutely an audience for it. I mean, I'm not sure what that translates. I mean, the stats I know about the U.S. are that it's 50 to 70 million Americans don't have access to credit. I think the unbanked stats a little different. That's obviously, but there is a huge U.S. population that doesn't have access to credit, somewhere between 50 to 70 million. And we are obviously, so there is absolutely a big opportunity to help and to provide services into that market. But the thing is as well is it's not just about financial inclusion and credit. I mean, we've also started building out value propositions for insurers. So what we're now doing is just like we can turn a retailer into a credit bureau, we can turn a retailer into a provider of insurance data services, for instance, healthy food scores, so that the insurer can offer lower premiums on people's eating habits and behaviors, right? Because as we said earlier, that same basket that we're using to predict somebody's likely to default because they are buying healthily, not drinking too much alcohol, so on and so forth. Well, it can also be used to determine somebody's eating habits, and that can be done on a calorie basis in many different ways. I mean, we also, so that becomes super valuable to insurers. We've also shown, for instance, that shopping behavior is predictive of lapse risk, whether somebody's going to lapse on their policy or not, because you can determine somebody's life cycle in terms of their employment history by what they're buying. Somebody goes off and he's buying Lindt chocolate last month, and now it's white label washing powder. These things are quite, they're quite predictive and accurate determinants of how people's lives are changing at different points in time. And what's good about it, I think, is that this is a lot more frequent. You're looking at these things and seeing it in week chunks as opposed to years apart. So if you think about what happened during COVID and people losing their jobs, losing their homes, and that happens in a blink of an eye. But there's no ways that the Bureau can determine that in that moment, because the history of the data is much older, and the way that process has been built out is expecting a much longer term, timeline of data. So there's other opportunities here that we're still working on that I think are going to absolutely, kind of help the financial services sector rethink how this can be done.
That's amazing. And as you were talking, I was like, the retailers that I use, I need to have Omnisient there, because if they saw my eating habits, I think my insurance premium will skyrocket. It's an inside joke to my friends, because I eat like the same thing. I eat extremely clean and healthy. So unfortunately, I don't have anyone monitoring that to give me benefits from that besides just good health. But I would totally love to get rewarded on that. So I think that's
absolutely, and you should be rewarded. There should be benefit, right? And actually, it's more, again, it's one of those things of bringing, like what we talk about. We talk about the data of people's lives, and if you can bring that into play in a way that benefits people in a privacy safe way with a consent-driven process. So you would, no doubt, if an insurer came to you and said, "Hey, I'm going to drop your premiums by $100, mate. You just live incredibly healthily, and it's just worth our while. And have you got any friends actually that we can insure as well?" So yeah, I mean, that's actually how it should work. I mean, it's how it should actually work, I think.
No, I mean, look, that's totally amazing stuff. I'm actually blown away by that. I like it. Where do you see this whole process in terms of managing, getting this type of data and leveraging it for verticals like fintech, insurance? Where do you see that going in 5-10 years? I don't know what happened.
Yeah, I mean, yeah, sorry, can you still hear me?
Yeah, but there was some background issue, but I think we're good. We're good.
Okay, cool. Yeah, so look, I mean, the scenarios of how this plays out is kind of interesting. I mean, just going back to this idea that 1.7 billion, 2 billion people don't get access to credit. We, in our local market, have improved their credit situation by 20% just in an instance of working with a provider that could help us solve this problem at scale. And if we made that 20% impact on a global scale, right, then you're talking about 400 million people that you could bring into a credit economy, and what that does to the society and to the economy of that country is massive. So I think the scale of what can be achieved is huge, and it's good to dream big, and it's more about, I think what we're seeing is the market we operate in is an interesting one, because it's kind of a mix of first and third world. I can solve first world problems, and I can solve third world problems. You don't typically see, except in major markets like the US and the UK and Europe, a loyalty program with a retailer at scale in the 20 millions, right? I mean, that's, you're talking, now you're talking kind of at a serious retailer in the US or in the UK or in Europe. So it doesn't actually happen like that in the rest of Africa. In the rest of Africa, those kinds of programs don't exist. But what there is there's telco data, right? And there's fintech data, and there's other kinds of data sources. And I think that's where we're starting to move into, is these more adjacent markets, because what you can start doing there is, and it's something we're starting to work on now with payment, with payment tech, where you can actually use that data to score a merchant's likelihood to be able to pay a loan. So if you could actually help a small to medium-sized enterprise business get a loan through the bank because of their turnover, that's the kind of thing. So those things become really, really powerful, because everybody knows that small to medium-sized enterprises drive the economy of most countries. So if you can actually start helping those guys, less failures in the SME game, in terms of businesses, more successful businessmen. I mean, if you could just 5% of small to medium-sized enterprises are more successful and don't fail. It's massive. It's massive what that does for an economy of a country. So I definitely, the thing is, the horizons are, there's a lot of possibilities out there, but I mean, I think that's where we think we can make a difference. Yeah.
No, I think that's amazing. What you're doing. It's a really and you know what? And I appreciate this conversation because I learned a lot. I mean, I do the show selfishly because I get to talk to really amazing individuals like yourself about new and innovative technologies, and I'm curious, technical also, so I get to ask these questions and drill in. So I really appreciate your time. What I'm going to do, Jon, I'm going to give you the floor to talk about your company, yourself, how people can find you, and then we will close it out. So I'm going to give you the floor right now to do that.
Cool. Thanks, Namdi. Yeah, so obviously I'm Jon Jacobson. I'm the CEO and Chief Technology Officer at Omnisient. You can find us on omnisient.com. So we just spell it a little differently. It's omnisient.com. So there's no C in Omnisient. You can also find me on LinkedIn. Connect with me. Keen to hear what everybody else is doing out there, especially founders, people that are interested in getting into the tech startup space. Happy to talk about my experience of what's going on. Yeah, and thanks very much for the opportunity, Namdi. Really appreciate it.
What I'm going to do right now, so people might have a problem spelling that, I'm just going to put it in the chat and then add it to the show so people can see it. There we go, right there. That's how you spell it. So it's now part of the show forever. It'll be on YouTube, and you can just pause it and look at the website right there. As Jon mentioned, you can find them on LinkedIn. Absolute pleasure. Thank you very much for your time. Like guests that have these types of really niche specific topics and industries that they focus on within fintech, I like to call them a friend of the show, because when news comes up now about retail, especially with data, with stuff like that, I want to bring you back on to really get your take on it and help people understand what's going on, because that's a huge market. That I was at the Money 2020 conference, and I met a lot of, well, not a lot, but I met a few companies and individuals that work for companies that deal in the reward space and so forth. So it kind of opened my mind to that, because I wasn't really thinking about it prior, besides being an end consumer of the reward side. So there's a whole like different business models there. So, when certain things come out and we want to help our audience understand it, I want to also understand it. I'm going to call upon you and you help us break it down.
Sure. Happy to.
I know it's late where you're at South Africa at this time, so I'm going to let you get on with your weekend. Once again, thank you very much. Also, for everyone else, let me add something. If you want to get exclusive content, top industry news, and so much more, join our mailing list. You can find our mailing list at Tech Behind FinTech /subscribe. So there you can go and join our mailing list. You'll get access to exclusive content, top industry news, and so forth. We are building that out. As always, thank you very much for your time. You guys are awesome. Thanks for rocking with us, everyone on Facebook, LinkedIn, YouTube, Twitch, and Instagram. I see you, and we are out. Cheers.
Bye.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.